Imagine waking up one day and realizing that you missed out on the greatest financial revolution of your lifetime. Imagine watching others turn thousands into millions while you sat on the sidelines, hesitant, waiting for the perfect moment. Let me tell you something, that perfect moment never announces itself. Right now, the crypto market is standing on the edge of something massive. The question is, will you be on the right side of history? The signs are everywhere. The market is heating up. Institutions are positioning themselves, regulations are shifting, and the big players are making their moves. But most people, they're still asleep at the wheel. So today, I'm going to wake you up. I'm going to break down exactly where the crypto market is headed, why it's on the verge of a breakout, and most importantly, how you can capitalize on it before it's too late. The past year in crypto has been a wild ride. Crashes, regulatory uncertainty, fear, and doubt. We've seen prices tumble, investors panic, and skeptics celebrate. They said crypto was dead. They said it was over. They were wrong. Because behind the scenes, something else was happening. Something that the mainstream media won't tell you. The biggest institutions in the world, BlackRock, Fidelity, Goldman Sachs, were quietly preparing their entry. They weren't running away from crypto. They were accumulating. And now, as we stand at the beginning of 2025, we are seeing the first signs of a market ready to explode. The foundation is set, and the conditions are aligning. The breakout isn't coming. It's already starting. For the past 2 years, the crypto market has been through one of the most brutal bear markets in history. Projects collapsed. Scams were exposed. Regulations tightened. Prices plummeted. The media called it the end of crypto, again. And yet, here we are. Bitcoin is rising again. Ethereum is surging. Altcoins are waking up. Institutions are making moves behind the scenes. One of the most compelling indicators of the crypto market's readiness for a breakout is the significant influx of institutional investment. Financial behemoths like BlackRock have not only recognized the potential of cryptocurrencies but have actively integrated them into their portfolios. Larry Fink, CEO of BlackRock, has been notably optimistic about Bitcoin's future, suggesting that its value could quintuple if sovereign wealth funds increase their allocations to the asset. BlackRock's management of a $60 billion Bitcoin ETF underscores this confidence. Fink posits that even a modest allocation of 2% to 5% from large investors could propel Bitcoin's price to $700,000. This institutional endorsement serves as a powerful validation of cryptocurrencies, dispelling lingering doubts about their legitimacy. As more institutions allocate capital to digital assets, we can anticipate a cascading effect, driving prices upward and attracting further investment. Regulatory clarity has long been a barrier to widespread crypto adoption. However, recent actions by the US government signal a paradigm shift. President Trump's executive order establishing a cryptocurrency working group marks a pivotal moment. This group, comprising top administration officials and financial regulators, is tasked with formulating a federal framework for digital asset trading and exploring the creation of a national digital asset reserve. Such proactive measures indicate a governmental acknowledgement of the importance of cryptocurrencies in the modern financial landscape. By providing clearer guidelines and fostering a more crypto-friendly environment, these developments are likely to encourage both individual and institutional participation in the market. The maturation of blockchain technology has addressed many of the scalability, security, and interoperability challenges that previously hindered the crypto market. Layer 1 and Layer 2 solutions have enhanced transaction speeds and reduced costs, making platforms more efficient and user-friendly. Moreover, the integration of blockchain into traditional financial systems is becoming increasingly prevalent. Tokenized real-world assets, decentralized finance, DeFi platforms, and crypto ETFs are gaining traction, bridging the gap between conventional finance and the crypto world. This fusion not only broadens the utility of cryptocurrencies, but also attracts a wider audience, setting the stage for substantial market growth. One of the most critical factors influencing the trajectory of the cryptocurrency market in 2025 is political endorsement and regulatory policy. While the past decade has seen governments worldwide struggle to define their stance on digital assets, we are now witnessing a significant shift, especially in the United States. The US government, under the leadership of President Donald Trump, has moved towards a more crypto-friendly regulatory environment, which could have a profound impact on the market's future. This section will explore the political developments shaping the crypto industry, from Trump's evolving stance on digital assets to legislative efforts that could redefine the landscape. We will also examine how these changes impact investors, businesses, and the broader financial market. Donald Trump's relationship with cryptocurrency has been a complex journey. Back in 2019, during his first term, Trump made headlines for stating that he was not a fan of Bitcoin and other cryptocurrencies. arguing that they were based on thin air and could facilitate illegal activities. At the time, the administration took a cautious approach, focusing on increased regulations and oversight, rather than fostering innovation in the sector. Fast forward to 2024 and now 2025, Trump's perspective has shifted dramatically. Instead of viewing crypto as a threat, he has embraced it as an opportunity. One of the most significant developments has been his vocal support for Bitcoin, Ethereum, and even meme coins associated with his brand. Trump has actively engaged with the crypto community, and his campaign even accepted cryptocurrency donations, signaling a broader acceptance of digital assets as part of the financial system. In early 2025, Trump signed an executive order establishing a cryptocurrency working group, composed of top administration officials, financial regulators, and industry leaders. This group's primary task is to develop a comprehensive federal framework for digital asset trading, taxation, and security. The executive order also included a proposal to create an official U.S. Bitcoin reserve, a move that sent shockwaves through the financial industry. By advocating for clearer regulations and even discussing the possibility of a government-backed digital asset, Trump has effectively positioned himself as the most pro-crypto president in U.S. history. This shift in policy and rhetoric provides much-needed confidence to investors, as it signals that the highest levels of government are now recognizing the legitimacy of crypto assets. For years, the U.S. Securities and Exchange Commission, SEC, has been a thorn in the side of the crypto industry. Under the leadership of former SEC Chairman Gary Gensler, the agency pursued an aggressive enforcement strategy, launching lawsuits against major crypto exchanges like Binance and Coinbase. The regulatory uncertainty created by these actions made it difficult for businesses and investors to operate confidently in the market. However, the political shift under the Trump administration has led to a restructuring of the SEC's approach to crypto regulation. With a new chairperson at the helm, there are now efforts to differentiate between digital commodities, like Bitcoin, and securities, such as certain tokens issued through initial coin offerings. This distinction is crucial because it clarifies which assets fall under SEC jurisdiction and which do not. Additionally, several pro-crypto bills have gained traction in Congress. The Digital Asset Market Structure and Investor Protection Act. This bill aims to establish clear guidelines for defining and regulating digital assets, providing businesses with a more transparent legal framework. The Stablecoin Innovation and Protection Act. This legislation focuses on regulating stablecoins while promoting their use in the traditional financial system. The Blockchain Innovation Act. Designed to foster blockchain development in the U.S., this act seeks to encourage innovation by reducing bureaucratic red tape. These legislative efforts suggest that 2025 could be the year where the crypto industry finally gets the regulatory clarity it has been demanding for years. One of the most controversial but groundbreaking ideas proposed by the Trump administration is the creation of a U.S. Bitcoin reserve. While details are still emerging, the concept revolves around the government holding Bitcoin as part of its national reserves, similar to how countries store gold. If this proposal moves forward, it could have several major implications. The U.S. holding Bitcoin would signal to the world that digital assets are a recognized store of value, potentially increasing global adoption. With the U.S. government acquiring Bitcoin, a significant portion of available BTC could be removed from circulation, leading to scarcity-driven price increases. If the U.S. uses Bitcoin as a financial hedge, it could counterbalance economic threats posed by other nations, particularly China, which is aggressively advancing its digital yuan. While some critics argue that such a move could introduce volatility risks to the national economy, supporters believe it is a necessary step to maintain U.S. dominance in the financial sector as the world moves toward a digital economy. Such high-level support not only legitimizes cryptocurrencies, but also paves the way for policies that facilitate their adoption and integration into the broader economy. The crypto market has evolved from a speculative playground to a more mature and sophisticated ecosystem. Investors are now better informed, employing advanced strategies and tools to navigate the market. The availability of comprehensive analytics, research, and educational resources has empowered investors to make data-driven decisions, reducing volatility and fostering a more stable market environment. This maturation is also reflected in the diversification of investment products, such as crypto ETFs and structured financial instruments, which provide investors with varied exposure to digital assets. As the market continues to mature, it becomes more attractive to a broader range of investors, further fueling its growth. In an era marked by economic uncertainty, inflationary pressures, and geopolitical tensions, cryptocurrencies have emerged as a viable hedge against traditional market risks. Their decentralized nature and limited supply make them an appealing store of value, akin to digital gold. As investors seek to diversify their portfolios and safeguard against fiat currency devaluation, the demand for cryptocurrencies is poised to increase, driving market expansion. Emerging markets have long been the focus of discussions around cryptocurrency adoption, due to several unique factors that make digital currencies particularly appealing in these regions. Countries in Africa, Asia, and Latin America are leading the charge in adopting crypto solutions, fueled by factors like inflation, limited access to traditional banking services, political instability, and a desire for financial inclusion. For example, in countries like Venezuela, Zimbabwe, and Argentina, where inflation and hyperinflation have caused local currencies to devalue rapidly, cryptocurrencies like Bitcoin have emerged as a safe haven for preserving wealth. In these economies, individuals and businesses turn to cryptocurrencies to protect themselves from the devaluation of fiat currencies, as crypto assets like Bitcoin have a limited supply, making them a hedge against inflation. Additionally, many people in emerging markets lack access to traditional banking services due to infrastructure challenges. According to the World Bank, around 1.7 billion people worldwide are unbanked, and the majority of them live in developing economies. Cryptocurrencies can solve this issue by providing financial services to those who have been excluded from the traditional banking system. The rise of mobile wallets, peer-to-peer payment systems, and decentralized finance, DeFi platforms, is enabling a new era of financial inclusion in regions that have been underserved by traditional financial institutions. The proliferation of smartphones and the growing accessibility of mobile internet in emerging markets are significant drivers of crypto adoption. In countries where physical banking infrastructure is sparse or non-existent, mobile phones have become the primary means of accessing financial services. For example, mobile money services like M-Pesa in Kenya have revolutionized how people in East Africa conduct transactions, and similar innovations are spreading across other regions. With more than 5 billion mobile phone users globally, the accessibility of digital currencies through mobile devices is increasing rapidly. This makes cryptocurrencies a more practical solution for people in emerging markets, who may not have access to a bank branch, but can easily use their phones to send, receive, or store digital assets. Furthermore, internet penetration is on the rise in many emerging markets, with an increasing number of people gaining access to the internet via smartphones and low-cost data plans. As more people become digitally connected, they gain access to decentralized applications, dApps, decentralized exchanges, DEXs, and crypto wallets, further driving the adoption of digital assets. The ease with which people can now engage in the crypto market directly from their phones makes this an ideal time for cryptocurrency to gain widespread use. Emerging markets, especially in regions like Africa, Latin America, and Southeast Asia, are often characterized by political instability and economic uncertainty. In countries with volatile political environments, local currencies are subject to frequent devaluations, capital controls, and inflation. As a result, people in these regions are increasingly looking for alternative ways to store and transfer value, and cryptocurrencies offer a safe haven from government-imposed restrictions. For instance, in countries like Nigeria, where government-imposed capital controls and frequent currency devaluations have led people to seek alternatives to their national currency, Bitcoin and other cryptocurrencies have gained popularity as an alternative store of value. In countries like Turkey, where the Turkish lira has lost significant value due to inflation and political uncertainty, many people are using Bitcoin to protect their assets and engage in international trade. Cryptocurrencies like Bitcoin, which are decentralized and not tied to any government or central bank, offer an attractive alternative for individuals in emerging markets who want to avoid the risks associated with traditional fiat currencies. In times of political unrest or economic uncertainty, cryptocurrencies provide a way to preserve wealth, make international transactions, and engage in cross-border trade with minimal government interference. The rise of decentralized finance, DeFi, is another key factor driving the growth of the crypto market in emerging economies. DeFi refers to a set of financial services that operate on blockchain networks without intermediaries such as banks, brokers, or other traditional financial institutions. DeFi platforms provide a range of services including lending, borrowing, insurance, and trading, all through smart contracts and decentralized networks. DeFi presents a unique opportunity for people in emerging markets who have limited access to traditional financial services. For example, in countries where there are few banks or high barriers to accessing credit, DeFi platforms offer individuals the chance to lend and borrow assets, earn interest on their holdings, and trade digital currencies without the need for a centralized financial institution. In addition to offering financial inclusion, DeFi platforms can also provide higher yields on investments compared to traditional banks. This is particularly attractive in regions where inflation rates are high, and people seek to protect their wealth from eroding. By leveraging DeFi protocols, individuals in emerging markets can access financial products that were previously unavailable to them, opening the door to greater economic opportunities. While regulatory uncertainty has been a challenge for cryptocurrency markets in many countries, there's a growing trend toward regulatory clarity, particularly in emerging markets. Governments in several developing economies are beginning to recognize the potential benefits of cryptocurrencies and blockchain technology. In some cases, they are even implementing regulations that foster the growth of crypto-related businesses and services. For example, El Salvador made headlines in 2021 when it became the first country to officially adopt Bitcoin as legal tender. This move was seen as a significant step toward legitimizing cryptocurrencies in emerging markets. Other countries, such as Brazil, India, and Mexico, are also exploring the potential for integrating cryptocurrencies into their economies, either by developing regulatory frameworks or by implementing pilot projects. As governments in emerging markets start to embrace blockchain technology and cryptocurrencies, businesses and investors will have greater confidence in entering these markets. Clear regulations help reduce the risk of uncertainty and make it easier for crypto companies to operate within legal boundaries. Additionally, government support can lead to the development of infrastructure that facilitates the growth of the crypto ecosystem in these regions. Stablecoins, which are cryptocurrencies pegged to the value of a fiat currency, such as the US dollar, are gaining traction in emerging markets as a way to facilitate cross-border payments and hedge against currency volatility. Stablecoins offer the benefits of cryptocurrencies, such as fast, low-cost transactions and decentralization, while minimizing the price volatility associated with assets like Bitcoin or Ethereum. For businesses engaged in international trade or remittances, stablecoins provide an efficient and cost-effective alternative to traditional payment systems. In many emerging markets, where remittance flows are a significant source of income, stablecoins offer a way to send money across borders without the high fees typically associated with traditional money transfer services. By leveraging blockchain technology, stablecoins can make cross-border transactions faster, cheaper, and more secure, creating opportunities for businesses and consumers in emerging markets to engage in global commerce more easily. The cryptocurrency space in emerging markets also presents numerous investment and business opportunities. As the adoption of digital assets grows, there will be a surge in demand for crypto-related services, including exchanges, wallets, mining operations, and blockchain-based applications. Investors who recognize the potential of these markets and enter early can capitalize on the growth of the crypto ecosystem. In addition, businesses that are able to integrate cryptocurrency payment systems, blockchain technology, or decentralized applications, DApps, into their operations can position themselves as leaders in emerging markets. For instance, businesses in sectors such as e-commerce, entertainment, and gaming can leverage cryptocurrencies to offer new payment options, enhance security, and create innovative experiences for their customers. So what does all of this mean for investors? Greater market stability. Regulatory clarity reduces uncertainty, making it safer for institutions and retail investors to enter the market. Higher adoption rates. With government backing and political support, adoption of Bitcoin and other cryptocurrencies will accelerate. Price growth potential. The introduction of a US Bitcoin reserve and institutional investments could lead to supply shortages, driving up prices. New investment vehicles. With crypto-friendly legislation, expect to see new ETFs, index funds, and structured products designed for traditional investors. If you found this analysis valuable, don't forget to hit that like button to help spread the word. If you want to stay ahead of the latest crypto trends and financial insights, subscribe to the channel and turn on notifications so you never miss an update. And if you think your friends or fellow investors could benefit from this deep dive into the market, share this video with them. The more we stay informed, the better decisions we can make together. Thanks for watching, and I'll see you in the next video.